Hi guys, welcome back and let's begin with the last of the section C tackling questions series for your PM subject where I'm taking the last topic as ratios and quantitative analysis. Again, one of the most frequently tested topic, but I'll tell you it's one of the most easiest to solve topics because here you have a lot of calculations and those calculations only you'll be using to derive your theory answers, right? So it's one of the most easy topics, comfortable topics. Let's do this question of Yetco Company. Yetco Company operates a chain of 23 vacation resorts, each of which contains bedrooms, restaurants, and leisure facilities and has been trading for 10 years. All of Yetco Company's resorts are run as investment centers. That means both profit, sales, cost, all are covered. And the return on investment, residual income, remember these portions will also be here since it is an investment center. Managers receive bonuses based on the return on investment. So it is a negative point, right? Because managers receiving bonuses. Now, and remember the negative points that we have read through it, like short-termism, manipulations, lack of goal congruence, lack of the long-term purposes to be met with, a loss for the company as a whole. So all these pointers now should come back to your mind because now you'll be using it here. The first two resorts in the chain were built in the same year by Yetco Company. They're identical in terms of design, construction, and the number of buildings. They were built in different locations in the same country and named after these locations, Uri and Lux. In recent years, the area surrounding the Uri resort has become highly fashionable and a much sought after destination for holidaymakers. The manager has made no significant capital investment. So Uri, though, is a very popular destination, but still the manager has not made any significant capital investments, so that it does not increases the capital, does not reduces its ROI. Dilution is not there. Probably that can be the reason for it. Over 2 years, the area in which Lux Resort is based is in decline and is much less popular destination for holidaymakers. But in order to make it more attractive and maintain custom, the manager at Lux has invested in high quality spa and gym equipments, more capital investments. So I think it will have lower ROI, as well as ensuring that all operations are run as efficiently as possible. Okay, I will come to this extract later, but let's see what all other pointers do we have. So we have net controllable asset for each whole percentage. So what do we have? Okay, let's have a look. An extract of the entity's budget for Uri and Lux resorts is as follows. Now just see how is the resorts details. So turnover is given to you, operating cost excluding depreciation is given to you, depreciation is given to you on controllable non-current assets only. That means here we don't have non-controllable assets pointer. Okay, and then tax is given to you. This is profit after tax. Okay, now controllable non-current assets are given to you, inventory, receivables, payables, and the total net controllable assets are given to you. This is capital employed, net assets. And to Yes, okay. And to calculate ROI, we also need PBIT, which is operating profit. So let's do it here. 3,50,000 less 2 lakh and less 26,000, which is 1,24,000. So this is your operating profit. 4,20,000 less 2 lakhs and less 60,000. We get here 1,60,000, which is your operating profit here as well. Okay, now I can calculate even ROI percentage. So what is the ROI percentage for Uri? 1,24,000 divided by 4,90,000 multiplied by 100. It is 25.3%. And here your ROI percentage is 1,60,000 divided by 7,70,000 multiplied by 100. 20.78%. Okay. For each a whole percentage achieved beyond 22% ROI, managers are paid a bonus of 5,000. That means here Yuri will get bonus, Lux will not get bonus as the percentage is below 22%. The resort ROI is calculated on controllable assets only, which therefore excludes the largest proportion of the resort's assets, which is land and building. Okay. In the past 5 years, the manager at Yuri has been awarded large bonuses because you can see here he has better ROI as well this year. Whereas the manager at Lux has received no bonus because he has probably because see the area that they are operating in has also got lower sales. But in spite of that, he has done investments to attract customers. So due to which the ROI is falling down. Yetco's average financial ratios are given to you here. Yuri in resort investment opportunities there for Yuri. The manager at Yuri has an opportunity to invest in the state-of-art solarium equipment at a cost of 20,000. The equipment will be used for 3 years before being sold off for 5,000. The solarium will generate a net cash flow for 8,000. The Yuri has a cost of capital of 10%. Let's see the requirements. It has got multiple parts, almost one, two, three, four questions. Calculate the receivable collection period, operating profit margin, and current ratio for Uri and Lux resorts and comment on their relative performance. 7 marks. So you can say that one, two, three. These three would be for around 6 marks, and this commenting is for around 1 marks. Okay, so let's do the calculations of receivable collection, operating profit margin, and current ratio. Now, if I take here, and let's say I will write here Uri and Lux, then already we have calculated operating profit margin, which is 25.3% and 20.78%. Then receivable collection period, and we need one more is current ratio. Okay, let's calculate receivable collection period will be, what is the receivable here? 90,000 and the sales are 3,50,000. So receivable collection period will be 3,50,000 divided by 90 multiplied by 365. No, wait, I'm sorry, you have to calculate the days, my bad. Okay, so we will do 90,000 is the inventory divided by 3,50,000 multiplied by 365. So the days are approximately 94 days. Moving to the here to the next one, in case of Lux, it will be the receivables are 70,000 divided by sales are 4,20,000 multiplied by 365. We get here 61 days. And current ratio is current assets by current liabilities. Current assets is the total of this receivables and inventory, right? So receivables and inventory will be here 1,80,000 divided by liabilities is 40,000. I get here 4.5. It is more than the ideal ratio of 2:1. That means there's a lot of idle funds here. And for the Lux, it will be again 1,10,000 divided by 40,000, which is 2.75. Again, even after doing so much of investments, Lux also has some um, idle money involved. Now, how can we comment on it? We can comment that, see, when I compare Yuri's performance with Lux, I find Lux performance is much better because even though its operating margin is lower than Yuri, and both of them have operating margin lower than the entity as a whole, but still Yuri's the receivable collection period is less, which means they are even with the downturn, even with such the environment that they are in, still they are able to have better collection than Yuri, which is in a place which is highly demanding. So ideally there should be very very less credit period there because it is highly demanding. So people would come and stay in the property and pay them quickly. But here they are given time. They are giving time to the customers to pay, probably because it is not as attractive as maybe other places in that vicinity, because it has not been upgraded with the capital investments also, right? So because of which it is really not so popular. Current ratio, you can see it's so high for URI. That means they have idle funds to invest, but still they're not investing. The reason being they don't want to dilute their ROI. So they're just looking into their self goals and the short termism and manipulations rather than looking into the long term perspective of the entity. Clear? The next question, calculate the ROI both URI and Lakshya resorts, that we have done, and state which manager will receive the bonus. That also we have done, so 3 marks done, URI will receive. Explain the problems with the current bonus system and yet go. See, the current bonus system is not correct. The reason being just linking the ROI as the performance measure would make that the managers are only going to look into the short termism and the manipulations, ignoring the long term objectives of the entity, and so it will affect the overall profitability of the entity because they may just lose on investment projects so that their ROI doesn't get diluted, right? So they are, so URI is earning bonus over the years. That means even now they're not looking into investments, because if they do investments, then more cost will be there and ROI will be diluted, due to which the bonus can be lost, right? So they are looking into the self interest more, and which is not the case with Lux. Even with such downturns, they have better ratios than URI. That means they're doing well, but still they are not being given, or URI resort people, the Lux resort people, they're not being given bonuses. So therefore, it shows that it is a wrong measure to evaluate the performance of the employees here. Okay, it should be maybe done with a combination of RI or maybe with another performance measure criteria also, by not just focusing on ROI only. Clear? Calculate the divisional the URI resort's divisional ROI if the new investment opportunity goes ahead, and whether URI's manager will make a decision on this or not. Let's see. So here, URI's existing PBIT is 1,24,000. Okay, now the revised will be what? So the new ROI, let's calculate new ROI. So for that, I would need, what is the revised PBIT, okay, including the new investments. So existing was 1,24,000. With this, I will add the inflow is 5,000. It will know. 8,000 is a net cash inflow. Outflow, the expense will be depreciation. No, it is given here. 3 years is the life, and it is going to be sold for 5,000. So depreciation will be 20,000 less 5,000 divided by 3. 15,000 by 3 is 5,000. So 5,000 is the depreciation per annum. Cash flow each year is 8,000. So the net effect is 3,000, right? So here I will add 3,000 each year, which will be 1,27,000. What will be the capital employed? Existing is how much? Okay, now let's calculate capital employed. Earlier capital employed was 4,90,000. With this, we will add the new investments, which is 20,000. So capital employed will be 5,10,000. What is the new ROI then? If we go with this project, it will be 1,27,000 divided by 5,10,000 multiplied by 100, 24.9%, which is lower than its existing ROI of 25.3. So definitely manager will not like to dilute its ROI and affect its bonus. Even if it is long-term benefitable for the organization, still manager will not take it. So which can prove, as a notional loss also for the organization. Even though when I'm saying this, I'll say that it is more than the entity's cost of capital and the URI's cost of capital. It goes cost of capital. So ideally, this should have been accepted as it would have been beneficial for the entity in the long run, right? So because of looking into the short termism, the manager will not accept it. Clear? Done. Was this difficult? No. Okay, so I'm answering from your behalf. Now, guys, these are just 5 questions that I took just to make sure that these 5 concepts are absolutely clear to you. Okay, I am going to come up with next a video on a quick revision for your PM syllabus in under 6 hours. So I hope that you will watch it and you will get, all of you will, get a thorough revision before your exams. So don't forget to like, subscribe to my channel and follow for more such ACCA videos, updates, PM, tax, ATX and the different topics. Thank you. Study well, study hard.